Welcome to this explainer. Today, we're going to dive into a massive, totally hidden shift in consumer finance that is quietly trapping millions of people. When we think about debt, we usually think of the big stuff, mortgages, auto loans, or just heavily maxed out credit cards. But right now, there is an entirely parallel credit system operating completely out of sight, and it is fundamentally reshaping the financial health of everyday consumers. Let's figure out how this is happening.
So, let's start with a mystery. Picture this. On the morning of March 7th, a 27-year-old graphic designer down in Austin, Texas, opens up her banking app. It's just 2 days after payday, and she is staring at a negative balance of minus $412. Obviously, she frantically scrolls through her transactions, right? She's looking for a fraud charge, maybe some weird banking error. But there's no mistake. Actually, every single one of those charges belonged to her. She hadn't taken out some predatory payday loan, she hadn't swiped a traditional credit card, and she definitely didn't walk into a local bank to borrow money.
The real shocker was the total number she finally calculated. Over the course of 14 months, she had just been casually tapping a button that said Pay in 4 on practically every online purchase she made. You know the drill, a jacket here, a desk lamp there, maybe a new phone case. Well, by the time she sat down and added up every single active installment plan she had across all these different platforms like Klarna, Afterpay, and Affirm, she owed a staggering $3,800. She was carrying nearly $4,000 in completely invisible debt that absolutely no bank and no credit bureau could even see.
And when someone asked her about all this spending, her response was so telling. She just said, "It's not really debt, I'm just splitting the payment." That quote right there, that perfectly captures her mindset. And honestly, the mindset of tens of millions of Americans right now. People genuinely, truly believe they are being responsible. They think they're outsmarting interest and managing their cash flow exactly the way the slick checkout page tells them to. But we're going to break down exactly why this belief is a very carefully engineered illusion, and how the cost of believing it just compounds every single month.
All right, Section 1, the Pay in 4 illusion. Let's get into how this model actually functions beneath the surface.
It's crazy how a simple point-of-sale financing pitch can so quickly snowball into a total cash flow nightmare. The setup is simple. You buy something, you pay 25% up front, and the rest just gets split into 3 more payments over 6 weeks. I mean, it sounds incredibly consumer-friendly, doesn't it? But the trap snaps shut when multiple 6-week payment cycles start overlapping with each other. And more importantly, they start overlapping with your basic, totally non-negotiable living expenses, things like rent and your utility bills. Because there is a massive, massive gap between the marketing pitch and reality here. The pitch promises no interest, instant approval, super simple. But the Consumer Financial Protection Bureau pulled the data, and it reveals a much darker story. Because 63% of borrowers are hopping between multiple platforms, your average user is actually stacking 12 to 13 separate loans at the exact same time. And it gets worse. These same users carry, on average, $871 more in traditional credit card debt, meaning standard revolving balances racking up high monthly interest, and $453 more in personal loans than people who don't use these services. They're not avoiding debt at all, they are just stacking it.
Moving on to Section 2, the rise of phantom debt. We need to understand why the traditional banking system is completely blind to this.
Regulators have started calling this phantom debt. See, when you tap that Pay in 4 button, no hard inquiry hits your credit report. There is literally no official check that leaves a paper trail. The majority of these providers haven't even been reporting these loans to the 3 major credit bureaus. So think about that. You could have 10 active loans across 5 different apps, and if you walked into a dealership to apply for a car loan the very next morning, your FICO score would show absolutely 0 installment obligations. It's a completely invisible ghost layer of borrowing.
And because this whole process feels so slick, so modern, and so detached from traditional, stuffy banking, it breeds massive misunderstandings. A lending tree tracker from February 2026 flagged a staggering misconception. 62% of users wrongly believe that using Buy Now, Pay Later is actually building their credit score. Let me be clear, it doesn't. Because most of these providers do not report your on-time payments, you get absolutely 0 credit boost for being a responsible borrower and paying on schedule.
Which brings us right into Section 3, the toll booth with no receipt. Let's look at how wildly uneven this playing field is.
I call this a toll booth with no receipt for a very specific reason. If you do everything right and pay on time, nobody notices, and your credit score doesn't budge an inch. The upside is entirely invisible, but the downside? Oh, the downside is permanent. If you miss just one payment, you get smacked with late fees, usually around $7 or $8 depending on the app, and those can cap out at a whopping 25% of the original purchase price. And if you default entirely, they will absolutely send that account to collections. That hits your credit report like a freight train and haunts you for 7 long years.
And the reality is, people are falling behind rapidly. According to that same Lending Tree report from April 2026, late payment rates are just exploding. Back in 2024, it was 34%. By 2025, it jumped to 41%, and by 2026, an unbelievable 47% of all Buy Now, Pay Later users had made a late payment in the past year. Just process that for a second. Nearly half of the people using a product that's specifically marketed as easy and painless are actively falling behind.
But honestly, what's genuinely terrifying is what people are actually financing with these loans now. The data shows that 29% of users are now financing basic groceries. That is double what it was just 2 years ago. And if you look at Gen Z users, it hits 38%. We're no longer talking about people financing a luxury vacation or a new gaming console. They are literally splitting a basic trip to the supermarket into 4 payments because they cannot afford to eat without borrowing. This whole thing has morphed from a fun convenience tool straight into a desperate survival mechanism.
So let's take a step back and crunch the numbers on the massive wealth destruction happening quietly in the background. Let's go back to our graphic designer in Austin. She kept an average outstanding balance of about $1,900. Now, if she had taken that $1,900 and invested it into a basic S&P 500 index fund, earning, say, a 10% average annual return, look at the opportunity cost. In 30 years, that money would have compounded into over $33,000. She didn't just lose the $3,800 she spent on stuff, she lost the $33,000 that money was supposed to grow into for her future.
Section 4. An unregulated $70 billion industry. Now, you're probably asking yourself, how on earth is an industry this huge operating like this without the government stepping in?
Especially when the Richmond Federal Reserve estimated this hit $70 billion in transaction value by 2025. Well, what we are witnessing is sheer regulatory chaos. Back in May 2024, the CFPB actually tried to classify these providers as credit card issuers to force some basic billing and dispute protections. But by May 2025, they completely withdrew the rule. This literally leaves consumers today with fewer financial protections than they had carrying a department store card back in the 1980s. And as of May 2026, lawmakers are still just writing strongly worded letters to credit bureaus asking how this is all being tracked. The regulation is just light years behind the tech.
And that brings us to Section 5, the FICO score reckoning. This is the incoming shockwave that the friendly pastel-colored checkout page is never, ever going to warn you about. FICO announced they'd begin pulling this data into their scoring models starting in the fall of 2025. This means all of that invisible phantom debt, it's suddenly becoming very visible to banks and mortgage lenders. But here is the wildest part. 45% of users say they won't even change their habits, even if they know it'll tank their score. The apps have trained us so effectively. Think about it. The button politely says, "Pay later," completely masking the cold, hard reality that it really should just say, "Borrow now." The entire Buy Now, Pay Later ecosystem absolutely relies on you not looking too closely at your active installments. They want you hyper-focused on those tiny, easy micropayments, not the massive macro debt building up in the background. So the single most important takeaway from this explainer is this. Pull out your phone, open your apps right now, add up those totals across every single platform you use, and ask yourself, have you actually done the math? The button says pay later, but later is right now, and I guarantee the balance is bigger than you think. Thanks for joining me on this explainer, and seriously, take a hard look at those apps today.